Hey everyone, let's talk about portfolio management and specifically about portfolio rebalancing. Now, this is an important housekeeping task that a portfolio manager has to do, but it actually is a big driver of portfolio performance. If you let a portfolio drift without rebalancing, you of course risk essentially having it be overwhelmed by certain positions that have gained and being under-diversified in other positions that have lost. And so if you initially had an optimal set of, let's say, mean variance weights, they probably won't be optimal any longer as time goes on and some of your positions gain and some lose. So rebalancing in a way lets you bring things back into order, and it does so in itself in sort of a salutary way. By making you take some of the winning positions off the table, therefore reducing your exposure to stocks that have, or other risk assets that have recently gained, but at the same time also taking some profits in them, and then redistributing those profits into others that might have higher expected returns. So let's actually go through a few examples here. First, we got to load up a portfolio in Bloomberg's port function. So here we are in port already. We need to select a portfolio. We can go to more sources to see all the ones we've got available to us. The one that we will use is example port, just because of how simple it is, as you will see. And if we select, it comes up for us in the port tool. Now, you can see that this portfolio has 6 assets in it, and you can see that it is not necessarily very well balanced in terms of GICS sectors. And let's see what these assets actually are and how their weightings are balanced. It won't be too much of a surprise. This is actually the FAANG portfolio. We've got Google, Facebook, Netflix, Amazon, and Apple. And you can actually see that this is not terribly well balanced. We've got about twice of our portfolio weight in Apple as in, let's say, Google. And in addition to this, we've got one ETF. This is sort of to serve as an example of a placeholder security, maybe something where you're parking some of your portfolio weight before you redeploy it to others. So we'll think about how to handle that as potentially a separate issue. And so let's say we've got about 40% of our current portfolio wealth parked in that. Now, how can we actually optimize this portfolio? Well, the first thing we got to do is go to trade simulation, where the optimizer lives. So if we go to launch optimizer, that takes us to the optimization tool. And here we need to configure quite a few important parameters for our optimization. The first one is, what do we want to actually optimize? Well, if we want to follow sort of a portfolio theory approach here, we probably want to make a Sharpe ratio optimal portfolio, or in the case of this rebalance, bring this portfolio back to Sharpe ratio optimality. So let's go to maximize, and we'll maximize the Sharpe ratio. Now, how are we going to tell Bloomberg's port to actually maximize it? Well, first of all, Bloomberg's risk model is sort of a factor-based one. So first, I guess we better select what factors we'd like to follow. Let's go with US equity. We can pick a date on which we want to do it. The last trading day is fine. And now we want to figure out what securities we actually want to allow it to trade. So let's start with sort of a very simple case where we'll just let it trade anything or everything in our current portfolio. So the 5 FAANG stocks and the 1 ETF. Now, how much turnover are we willing to accept in this rebalance? For some trades, of course, we might want to limit turnover, but if we're doing sort of a big all-in-one portfolio rebalance, let's say every half year, we can be fairly permissive here. Let's say we'll let it trade up to 40% of the total portfolio. Now, do we want to allow some cash? In other words, should we, if we take some profits, can we put them into cash? Let's limit that just in case we have some other constraints, like we need to keep our wealth not in cash but in like an ETF, let's say. Let's set that to something low, and then the rest of it will go either into our individual equity positions or the ETF. But it's, I think, useful to give the optimizer that little bit of freedom, because sometimes it helps you get solutions, because this is not a analytical solution, it's a numeric optimizer. In fact, to sort of get a bit into the details of how the risk model works, so it's a factor-based one. We're not actually estimating a full variance-covariance matrix here. We're just estimating factor loadings, and then variances and covariances between those factors. But that, of course, is much more sort of robust than if we had especially a big portfolio trying to estimate a full variance-covariance matrix for. Now, the other thing we need to add is what the maximum weight is going to be. If your portfolio has some constraints, you probably won't want to leave this at 100. So let's say if we're doing sort of an equal weighted portfolio, we'll set everything to max 18%. Let's say max 20. And also we have to give it an expected return. This is just sort of a compliance issue for Bloomberg, since the Sharpe ratio optimization, of course, requires an expected return. They don't want to promise you one, so they're just asking you to put one in. And there are, of course, places where you can go to get estimates of what the expected return on equities going forward may be. If we're relatively pessimistic, when we put a somewhat low one of, let's say, 5%, we'll see where that gets us, but this is sort of an input that is up to you as the user. So with that, we're actually ready to give it a go. So let's press run and see what happens. So good news, we got a solution, and that's not something that one takes for granted. Sometimes the solution doesn't actually come out in case the constraints turn out to be infeasible. We did actually almost hit our turnover cap. Interestingly, our Sharpe ratio did not really improve, but what we did is we increased our positions in most of the weighted equities before. We reduced our position in our ETF, and that actually may be an undesirable outcome, especially if we were using that to sort of store our portfolio wealth before investing it. We probably don't want the optimizer to tell you, hey, you gotta get out of that and put it into something else, because we know we just might want to wait on that to do it later. But if we take these as given, we can actually see what this new portfolio is then going to look like. And you can see if you go to trade simulation, we're now in simulated trades mode, so it's essentially keeping our new simulation results for us for now as though they were the real portfolio. And once it finishes loading, we can see that, yes, indeed, our weights in the ETF have dropped precipitously. Our weight in Apple didn't change. Our weight in Google and Facebook and Netflix have all gone up. So this is one way that we could actually say we have now conducted an optimization. Here are our final weights. But let's say that we now aren't terribly happy with this idea that we wanted to sell off this placeholder ETF. So let's undo this set of simulations. Now, if we just unclick Simulate Trades, that'll take us back to what our original weights were, as you can see. So all of these simulated changes have now gone away. So now how else could we, if we go back to the optimizer, how else could we do things? Well, let's go back to Setup. And now let's say that we're just going to give it an exception. So for our ETF, let's say that the maximum weight on everything is going to be 20, but for our ETF, it can be as high as 45. In other words, this will give the optimizer a bit more freedom in adjusting asset weights, in that it doesn't have to sell off our placeholder ETF in order to meet that overall constraint that no security can be more than 20% of the portfolio. And remember, that's a constraint that we ourselves have imposed, but it's one that you will often see, sort of a maximum position size. So with that, let's actually give that a go, see how that plays out. Now you can see that we actually have now a slightly better Sharpe ratio, at least it didn't drop. We're now actually increasing a bit our weight in the ETF. That's fine, perhaps. And we can actually then go back to port to see what these simulated optimal weights would be like. You can see now that our ETF was not reduced. In fact, it was a little increased. And as far as the others, well, it looks like we actually reduced our position in Facebook and Netflix. We have increased our position in Google. We have reduced our position in Amazon. And we have reduced our position in Apple. So that is probably a more sensible solution. And yet another way to proceed, so let's also then take off these simulated trades, go back to where we started. Yet another way to make the optimizer not mess around with the ETF is to actually create an additional trade universe restriction. So let's go to that. Let's say we're going to add to our universe a worksheet. Let's just pick a random new worksheet, and we're going to make this a no trade list. So that means that whatever is in this worksheet, we're not going to buy or sell one way or the other. We're just going to leave that as it is. But now I suppose we'd better actually put something in there. And of course, the logical candidate for what we would want to neither buy nor sell is probably that big ETF position. If we put that in that worksheet, then we'll actually have this constraint that we're not going to mess around with that. We'll just optimize our individual equity positions, but still in the context of having that big position in the ETF. In other words, its factor loadings will still be taken into account for optimal portfolio risk and return encapsulated in the Sharpe ratio, but they won't, that position won't be changed. So let's actually go to our worksheet. Here it is, worksheet 22. So we've already got SPY in it, but let's actually see how we did that. So let's go to import, and we can actually import our portfolio constituents into that worksheet, which will make it easier to see what we want to keep and what we want to kick out from our, let's say, no trade list in this example. An important thing is we want to not sync to source, because that means that we can actually then change what this list of constituents is. And let's just say replace existing securities. So now we're going to get these 6 items that we have in our portfolio in there. And now if what we really want is to just keep the ETF, because that's what we want to say we want to not trade at all, we can then just delete the rest of it. So, good. Now worksheets are automatically saved, so we can actually just back out of that. And that should then actually be the security that we're going to be neither buying nor selling. So now we can actually probably get rid of this constraint, because now we're not going to be messing around with that ETF at all. And so let's see what happens if we run it. Okay, so that's looking encouraging. We got some trades. We are not trading the ETF as we specified. It looks like we're increasing our positions in Google, decreasing in Netflix, decreasing in Facebook, decreasing in Apple, decreasing in Amazon. So it looks like we're just selling off most of the FAANGs, putting them into Google. And if we look at analyze in port, we can actually confirm that now our ETF was neither increased or decreased, and it was just those individual equity weights that were changed. So yeah, here is our greater weight in Google, reduced weights in Facebook and Netflix, reduced weight in Amazon, reduced weight in Apple, and unchanged weight in the ETF. So this is perhaps an even better way to report or to create your optimal portfolio rebalance if you have an ETF that you don't want to adjust. Now finally, one other way to do it. Let's undo that optimization again. Let's now, again, you can see that all of our weights are back to what they initially were. Let's go to the optimizer one more time, and let's now say something different. Let's say that we want to just not increase our weights in the ETF, optimize everything else, and if we need to reduce the ETF, let's reduce it, but let's just not take extra positions in it, because again, it's sort of a placeholder account. We probably don't want to treat that as an active investment. We're taking bigger positions. So if we edit this trade universe restriction, let's just make that, instead of a no trade list, a no buy list. So we select that. Now, since it is going to let us sell it, we're probably going to need that maximum position weight constraint for that particular ETF again, because otherwise, if we're now letting the optimizer sell it, and we have this global maximum position constraint for all assets at 20% of weight, well, that means that it's going to reduce it to 20% or less. But if we now add that maximum constraint again, just so that right now we are below it, and since we're not buying, we're not going to go above it, certainly. But that just means that now the optimizer doesn't have to sell it unless it actually is optimal for it to do so. Other than that, everything is still the same way. US equity risk model, Sharpe ratio, 40% total portfolio turnover, 5% excess return. Let's run that. And so now we're again increasing our weight in Google, but perhaps not by quite as much. We are still reducing our weights in Facebook, Amazon. We reduced our weight a bit in the S&P 500 ETF, and we reduced our position in Apple. So we can view these positions in our portfolio. And this would sort of be the final way to handle rebalancing a portfolio with some positions that you want to treat separately. So this would be an example of one that you would just say you don't want to increase, but you're comfortable reducing. So then here are our final portfolio weights that we would report if this is what we were comfortable proposing. So again, these are just sort of candidate ways that one can go about rebalancing a portfolio. It just depends on how you want to treat that one position you want to treat separately. If there is no such position, then you can simply re-optimize everything and set a uniform maximum position size. But if you have a position like this, then these are some ways in which you can handle it. Thanks for listening.